Not only did I point these things out, but they didn't even know how to stop the fees. And when they finally, and I explained to them, they had to call the administrator just to find out who the advisor was. The HR director at the business actually had to Google the advisor's name. And upon Googling the advisor's name, the HR director learned and then informed the business owner and me that the advisor had actually been dead since 2014. So if that doesn't demonstrate the absurdity and the extreme opacity of this industry, I don't know what does.
Welcome to Investing for Generational Wealth. I'm John Lai from Clive Capital, where we help high earners just like you invest outside the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income, or cash flow and tax benefits. Together with you, we're investing in over 1,000 multifamily apartments under renovations, nearly 100 single-family rental homes under development, more than 350,000 square foot of industrial real estate, $700,000 of private loans, nearly 40 oil and gas wells, and we're expanding to other asset classes as well with the end goal of helping our investors, you, create diversified, balanced portfolios. Before we begin, as always, a quick disclaimer. We're not financial advisors. All investments are subject to risks, including the possible loss of the money you invest. So please perform your due diligence before making any financial decisions. And of course, consult your CPA and your attorney before making those investments. I'm your host, John Lai, and welcome to today's episode 401k Optimization, Maximizing Tax Deductions and Employee Benefits with Paul Sippil. Paul is a longtime auditor, accountant, financial advisor who has become a leading advocate for fairness, transparency, and optimization in 401k plans. And today's podcast, he'll uncover how many businesses unknowingly overpay in fees, miss valuable tax deductions, operate plans that don't truly benefit their employees, and how to fix it. Today's session is designed primarily for business owners. I'm really excited about this because I'm really interested in 401k plans and 401k plans as a business owner. But business owners who want to do right by their teams while improving financial efficiency of their retirement plans. And what we'll learn today include identifying those fees and those inefficiencies, maximizing tax deductions for business owners, improving employee benefits without really increasing any overall costs. For those who don't know your journey already, Paul, could you give our audience a brief history of how you got to where you are today?
Yes, absolutely. So I started off my career as an auditor because graduating, I went to University of Illinois at Champaign. They have a real good accounting program there. I figured starting off in the public accounting field would be a good way to start your career because accounting is like a language. It gives you a broad business background and potentially opens up doors for you should you ever want to change careers because it's such a good foundation. And that logic was sound. It didn't really apply to me because I still remember the very first day on my very first job out of college. I knew I just didn't like the work. I just didn't connect with it. But at that time, I really didn't know what else I wanted to do. So a couple of years later, I transitioned to a career at GE as an accountant. It was a pretty chaotic environment, but it was still accounting. I just didn't think I wanted to do public accounting. And then I realized I just didn't want to be in accounting at all. So I then moved on to financial services. I was at a firm called Lincoln Financial Advisors, where I focused on providing estate and succession planning strategies to business owners. And that was interesting work. But what was more interesting to me was a conversation I had with a colleague who told me how you can look up retirement plan tax forms online. That's 401k, profit sharing, 403b plans. And I just couldn't believe that information was a matter of public record, that anybody can see anyone's tax forms, not personally,
Hmm.
but for the retirement plan. So a few years later, because I didn't really know what to do with that information initially, I thought maybe I would start just making a few phone calls to business owners, letting them know what I saw on their tax form, and namely calling business owners where I saw especially high service charges that were being assessed, which are known as record keeping, administration, custodial, and advisory fees. And charges not just high, but disproportional to the level of number of participants and the level of services provided. I thought I would be a hero for pointing these things out, but the business owners would respond to me saying, I'm not paying anything, and or my
Hmm.
friend handles that. And I thought, I'm looking at your tax form. You can't deny this is happening. And all they ever understood was they're not paying anything at the employer level. And because they never got an invoice even to reflect the participant fees, even though I was looking at their tax form and because I was a stranger, they just really didn't believe what I was saying was true. And when
Right.
this happened over and over again, I realized I could make a whole career just consulting in this one area and just even focus on Chicago and still never get through to everybody because Chicago's a big city with lots of businesses. So that's essentially how I got started. But I do want to add that I decided to go off on my own because I was criticizing one of the record keepers that had an affiliation with my firm as one of the approved record keepers that advisors like us could recommend. And this company, John Hancock, was getting sued for excessive fees. And this was in the news and there were articles about it. So I would send some of these articles to prospective clients. John Hancock got wind of the emails I was sending because someone must have forwarded, or maybe multiple people did. And they saw my signature being with the firm I was affiliated with, and they knew they had a relationship with them. So they essentially told my firm, who then informed me that I could not only not criticize a company that my company had a relationship with, but I couldn't even use the database of 5,500 forms, that's the tax form for the retirement plans, as a prospecting tool. So not only was my firm actually not helping me acquire new business, but they were also taking a significant portion of my money because they need to take their cut. They were charging me an affiliation fee. I even had to charge as a broker, which is exactly what I was criticizing, because I really believe you should charge a fixed dollar fee that's commensurate in the way that you make money or commensurate with the level of services that you provide. And so you could actually send an invoice, which was what I was criticizing. So, given all that information, I thought, what am I doing here? And they were restricting who I could recommend as a record keeper. I realized I needed to go off on my own as an independent registered investment advisor, fiduciary, crime fighter, and forensic 401k consultant. So I wouldn't have anybody pulling my strings.
That's great. Thank you for that. That's a great background, and I'm glad to have you here today because of it. I'd be interested to know this, I guess the 401k optimization apply for large businesses as well as small businesses. Is it larger degree, the I guess the harm, larger degree at larger organizations because it is affects so many more people.
Now, you would think so, and that's a good question to compare large versus small plans. Now, the irony is that the large plans are the ones who actually get sued for excessive fees, but the degree of harm is minuscule in the large plans on a per participant basis versus the smaller plans, because all of the harm, at least legally, is larger in absolute dollars for the smaller plans. It's only like maybe an extra $30 per year per participant, but that adds up over thousands and thousands of people. So there's
Right.
more potential harm for attorneys in terms of getting a judgment, which makes it worth their time. But there's very little harm per participant in these small plans just because of their economies of scale. However, there is extreme harm in plans that are much smaller, like namely fewer than 100 participants, sometimes to the tune of $5,000 per year more than what they should be paying.
Hmm.
And that's just a crazy amount of money. I look at my credit card statement. If I have a $10 charge I shouldn't have been paying, I'm going to call my credit card immediately. Or if I can
Right.
save $10 to $20 a month, which I've done several times on my phone bill, we all know there's new deals that come out with our carrier or our internet service provider. And hey, we know what it means to save $20 a month. And that would normally bother a person if they're paying, let's say, for services they're not even using, or if they're paying for an unlimited minute cell phone package, but maybe they're not using their phone that much. So why pay for unlimited minutes if another package would more suit your level of usage? But the retirement plan industry doesn't work like that. It's not based on usage, it's based on assets. And what happens is these service providers wrongfully, although it's generally accepted practice, assess fees based on a percentage of the total account value, which isn't a big deal when there's no money in the plan. But as the account grows, and professional services firms, for example, have millions of dollars in these accounts and huge contributions that are pushing up the asset value, it's causing the fees to go up without any additional services being provided in return. And it's causing the fees to be completely disproportional to the level of services that are actually required, which for plans with few people is very little.
Got it. I understand. Okay. Thank you for that. And to be clear, and maybe this is a point of clarification for me, the fees are assessed to the employer or to the employee?
It's mostly, in most cases, to the employees. They always can be assessed to the employer. And this is the crazy part that people don't understand, that financial advisors, for example, who get paid through commissions, and not all of them do, others still charge an asset-based fee because commissions are also based on a percentage of assets, but they're embedded, buried within the cost of the funds. They can't be charged to the employer. They can only be paid through the fund. So you never want to do business with a broker. I don't like to make blanket statements all the time, but there's simply no value ever in any case to do business with a broker versus someone who's a registered investment advisor and fiduciary that does not receive any kickbacks or compensation from third parties. In many cases, the employer might pay a small portion of the fees, which is often billed directly by the administrator. However, the administrator often does get revenue known as sub-transfer agent revenue out of the accounts in addition to billing the employer. When the employer does pay some of those fees, they're under the impression that, oh no, we pay the fees. Yes, you pay the fees. You just don't pay all of the fees. And in fact, that
Hmm.
fee is only a very small portion of the overall fees that you're paying. And I can't even count at this point over the last 17 years how many arguments I would get into with business owners saying, I know that you're getting a bill for some of these fees, but the vast majority of the fees you've never gotten an invoice for, and those are being paid by the participants. Oh, and by the way, with non-tax deductible dollars. And this is the
Hmm.
most egregious part in terms of tax efficiency. Imagine you're an accounting firm. I want to use accounting as an example because even the accounting firms don't understand tax deductions. And that 90% of the money, 70, 80%, maybe whatever, the majority of the money, vast majority, is the partner's money, the owners. If most of the money is the owner's money, that means they're paying most of the fees because the fees are always passed on, not equally, although you could potentially do that, but it never happens that way. But they're passed on in proportion to the account balances, again, with non-tax deductible dollars. And you can't see them, so you're not going to be cost sensitive, as Milton Friedman described in his 4 ways to spend money. You can spend your own money on yourself, your own money on someone else's money on yourself, or someone else's money on someone else. And the latter is where you don't economize and you don't seek the highest value. In other words, you just don't care because you have no reason to be sensitive to the cost. But if you're paying at the employer level, it's all the partner's money anyway, and you get a tax deduction like you would for any other business expense, and you are paying for all of it out of your accounts anyway. You might as well pay at the employer level because not only will you be more sensitive to the fees, but nobody else will have to pay anything. And if financial advisors are touting these accounts, which they always do, as tax advantaged accounts that you should have as much money in as possible inside of, then why on earth would you then try to extract the maximum amount of money outside of in an account that you just said to stuff all your money into? It
Right.
doesn't really make any sense. And of course, you could use this as a recruiting tool versus other small firms who don't even know that they could pay these fees at the employer level. The Department of Labor did a study showing an example of a participant who's 35 years old that has a $25,000 balance. And over the course of the investing lifetime, 30 years until retirement at age 65, an extra 1% in fees, just an extra 1%, and oftentimes it's worse for that participant, and oftentimes it's worse when you have more money, or would be, that participant would pay 28% in additional fees, and in dollars, approximately $67,000 as a result of that additional 1% in fees. And if you explain
Wow.
that to a potential recruit, you're basically allowing them to receive significant additional compensation that other small firms that don't know to pay at the employer level would not be offering.
There's two sides of the coin as I see it. Like one side of the coin is companies should find an administrator that is not assessing these fees or over assessing these fees up front to get the right plan in place. And then the other side is I have a plan in place. Now, how can I go about investigating the fees?
Yeah, that's right. And any administrator can always bill you or record keeper. And there's different parties. I should take a step back and explain what these services are, because I don't know if everyone understands the differences
Please.
between these services. One is that the record keeper, and it's on my website, paulsippil.com, Sippil. It's not a sales pitch. This is just information about, and I always put this out there just so people know who are the providers, what do they do. Record keeping simply means keeping track of participant balances, keeping track of loans. It means providing a participant and employer website. What's really, there's different logins. You can log in as the employer, log in as the participant. It's an 800 number for both participants and for the employers. It's a platform of investments because different record keepers will restrict the funds in different ways. In some cases, there's very few restrictions. Some cases, there's a lot more. The administrator, however, while also dealing with compliance, specifically because record keepers deal with some compliance issues too, the administrator will actually prepare that 5500 form, which is the tax form filed with the Department of Labor. They'll perform what's called discrimination testing, which is these stupid arcane rules that prevent more highly compensated employees from maxing out their contributions unless there are sufficient contributions being made amongst what's known as the non-highly compensated employees, which is defined by an income threshold. And then there's a custodian like Charles Schwab, Fidelity. They're just the party that holds the money. And
Mhm.
financial advisors who all get paid in different ways. Some act as brokers where they're only able to provide investment education and recommendations versus registered investment advisors who are known as fiduciaries that can literally legally provide advice. However, most of these fiduciaries will still wrongfully assess fees based on a percentage of the total account value, which, as I've mentioned, is totally divorced from the level of services provided. You ideally want to find an advisor who's willing to charge a fixed dollar fee based on the number of participants and their time. And as an example, let's say you have 20% credit card debt and there's no match. Are you sure you always want to max out versus paying off that 20% debt? The financial advisor is going to lose money if you pay off the debt, but sometimes paying off that debt is the best thing to do. So, yes, you want to find the right provider who has, in terms of cost, services and technology, who has at least legitimately decent service. You don't necessarily want to opt for the cheapest, but you want to have one that has a fee structure that's in line with your needs. Then with existing plans, I need to point out to people that you can always negotiate with the advisor, although sometimes you don't even know you have an advisor. And as a quick story, I was just talking to a business owner about a month ago where I uncovered that they were paying about 30 grand a year in commissions over the last 3 years, but they didn't even know they had an advisor. Now, that might sound crazy, although that does happen a lot, but it actually gets much worse than that. Not only did I point these things out, but they didn't even know how to stop the fees. And when they finally, and I explained to them, they had to call the administrator just to find out who the advisor was. The HR director at the business actually had to Google the advisor's name. And upon Googling the advisor's name, the HR director learned and then informed the business owner and me that the advisor had actually been dead since 2014. So if that doesn't demonstrate the absurdity and the extreme opacity of this industry, I don't know what does. And
Right.
oh, by the way, I also instructed them because of all companies, guess who the record keeper was? It was John Hancock. Big shocker. And you can always ask, and usually they'll say yes, the record keeper, such as John Hancock, for a fee reduction. They're never going to offer a reduced percentage, but if you ask them, they'll often say yes because they'll assume you're smart enough to know to leave them if you're smart enough to know that you can negotiate the fees. So they don't send an invoice either. And this is the big problem with the industry is that not only do the participants pay, making employers insensitive to the cost, but I want to stress that it's just crazy that these providers just won't send you an invoice to create that what you might call renewal moment or reminder that there are fees coming out of the accounts and that you can always negotiate, or at least it might occur to you to negotiate. We can actually see them, but you can't negotiate what you can't see.
So what's the first step in investigating these fees? Is it to look at the Form 5500 for that particular company?
You could. A lot of times nobody looks at their 5,500, so they wouldn't even know they could look it up, although they have a copy probably somewhere. That's part of it. But ideally, you just want to either ask for a fee disclosure statement, which really doesn't very clearly disclose the fees in all cases anyway, or you literally get on the phone with your service providers and say, just tell me in dollars all the fees that we've been charged, let's say over the last 3 years. And then you could see the progression because I often email people when I go through years worth of their 5,500 forms, sometimes going back to 2009. They could literally see when I list them out every year how substantially they're increasing. And I show them how many participants they have, which is often the same. And we know what inflation is more than is let on, but the increases are so insane that there's no way that inflation alone would explain these increases. And when you see this progression of increases, it might stimulate some action and get people to ask, hey, why are you increasing our fees so much every year? We don't do anything more. We've never had any more service.
Right,
So
right.
it's literally getting on the phone with either the advisor, the administrator, or the record keeper, someone who serves you, and just asking, please tell me every single fee that we paid and don't give me any percentages. I want dollars.
Yeah. And do this on an annual basis because they could change the fees annually, or what's the periodicity of this?
That's a good question. The structure doesn't change. It's just that they're based on a percentage. Yeah, annually is fine. Once you understand how the fee structure works, you don't necessarily have to keep asking them because you already know. But the other problem is there's no price literacy. Price transparency just means you can see all the fees. But so
Right.
what? If you see it, how do you know that another provider isn't cheaper and provides the same level of service? You can't shop for a 401k the way you can shop for a car. And I know nothing about cars, but I know how to look at the Carfax report. I
Right.
know how to compare one used Toyota Camry to another. I know that if I'm buying an older Toyota Camry, that's going to put downward pressure on the price. I know that if there's been more accidents, that's going to put downward pressure on the price. I know if the car has more features and it's newer, that's going to put upward pressure on the price. And a novice like me can very easily understand that logic. But how do you do that with 401k plans in terms of
Right.
comparing the cost and features? And for that reason, it's not a market. It's not a functioning free market. And I'm trying to provide information just to make the market more efficient.
Oh, I see. Okay. That works. What about a business owner who says our plan is probably fine or is fine? I haven't really noticed any irregularities. What would you say to
I'd say, of course, you haven't noticed any
that?
irregularities. I haven't seen an invoice. And I would say, I know you haven't seen an invoice.
Yeah.
That's the problem. I haven't seen anything. I know that's what I'm arguing. It's because you
Right.
haven't seen anything. That's why you should be worried. This is why it's such a problem because I'm telling them something that completely contradicts their reality. And if their trusted advisors never told this, and I'm a stranger and I'm telling them something that's never been talked about, what I'm saying must obviously be false. So there's simply no way to reach most people unless they're the types that listen to podcasts like these and are
Mhm.
seeking out new knowledge and new information. You could literally show them their tax form and they're never ever going to believe you.
Yeah. Yep. How can a plan design dramatically change the amount an owner can contribute to a pre-tax? How much are we talking about? Is it on the order of a few dollars? I think you mentioned it. It depends on the contribution, obviously. Could you give more color of that?
Oh, yeah, that's another really thoughtful question. I don't always get asked that. So that actually gives rise to a different discussion about these plans. The reason that's such a good question is that it gets into how profit sharing contributions are allocated. Nothing you can do can change the pre-tax limits. The pre-tax limits, and that's true combined for what's known as the traditional and the Roth 401k. A lot of
Hmm.
people don't realize that you can do a Roth portion for the 401k. People ask, should I do a 401k or a Roth? And a 401k simply means participant contributions. A 401k can be a Roth, an IRA can be a Roth. And you can simply contribute up to the applicable limits, and you can contribute a catch up if you're over 50. There's some new rules where if you're 50 years of age or older and you're making, I believe, $150,000 or more in FICA wages, then your catch up contribution actually has to be made in the form of Roth. It's too
Mm,
bad that they're making you do that. For some people, maybe the Roth is a better option anyway, but that's become mandatory. Now, in terms of plan design, a lot of business owners, especially professional service firms that have a lot of, or at least a few or one highly compensated employee, will design the plan in such a way so that it's a new comparability cross-tested plan. And that's basically a way to disproportionately allocate more of the company contributions, being the profit sharing contributions, to the highly compensated employees, with only a minimal contribution having to be made to the non-highly compensated employees. There's
mm,
also a design called a safe harbor plan. The safe harbor plan enables you to not have to deal with the discrimination testing requirements, where let's say you give what's called a 3% safe harbor match, where you're giving a 3% contribution based on salaries to all the employees. And in return for that cost, because you're making sure other people are getting money too, then you as a business owner will not fail the test and will be able to max out all of your contributions. If you do fail these tests, and by failure, not have a sufficient level of contributions amongst the non-highly compensated employees, then unfortunately you get a redemption check at the end of the year where you tried to contribute up to the max, but you're
mm.
not able to. And
Right.
again, it's too bad that these rules are in place, because the contributions made by highly compensated employees are not harming the non highly compensated in any way. It's not in any way unfair that some people have the ability to contribute more than others, but you get penalized for it. That's
Got
nothing I can change yet, but I'm actually working on it, because there are ways to get these laws changed. You just have to be patient and be a little bit creative.
it. You mentioned this a little bit, I think, but what role do profit sharing and employer contributions play in that tax optimization?
Until I think actually this year, all profit sharing contributions had to be made pre-tax. I believe now, I don't think many people are doing it. And I don't even know if all the record keepers are set up to handle this. But in the future, more and more firms might start adopting, especially because the Roth is so advantageous to many of the highly compensated employees, that the profit sharing contributions can be made with after tax dollars. And one of the advantages of setting up an employer sponsored plan is that if you just have an IRA, you can't put employer contributions into an individual retirement account. And the profit sharing contributions are above and beyond what you can make as an individual employee. So if you're the owner of a business and you've already maxed out your 401k contributions, including the catch up, and there's also something called a super catch up, where you can contribute, I believe it's 11,250, although that might have even increased this year, if you're between the ages of 60 and 63, as opposed to what was the $7,500 catch up. And I believe now it's $8,000 this year if you're 50 years of age or older. But the profit sharing contributions are above and beyond the 401k regular and or catch up contributions. So that's a nice way for employers to max out. And then employers can also set up an additional plan known as a defined benefit plan, which could be a traditional defined benefit plan or a cash balance plan, which has a little bit more flexible funding requirements.
Got it. Okay, thank you. I remember from my audit days all those different plans, but and then maybe even had to audit a few of those plans myself.
Yeah. Oh, an audit, if you don't mind me interjecting, a
Sure,
lot
please.
of people, business owners will say, I was audited. And you have to have over it's like around 100 employees, like where if you have fewer than that, you don't have to go through an audit. I'm fine because I was audited. And I want to point out to everyone, and I used to be an auditor, but not for 401k plans, that whether or not you were audited has nothing to do with the reasonableness of the fees that you're being charged by service providers.
Thank you for that clarification. No, I'm assuming, and you probably heard about self-directed 401ks, IRAs, and the like. What you're referring to, does it apply to both traditional, I guess, non-self-directed as well as self-directed, or is self-directed a different animal, self-directed 401ks?
Okay, so I want to ask you to help me understand. I want to, because sometimes people use that term a little bit differently. There
Sure.
is something in a 401k, and it's a great point that you bring up, called a self-directed brokerage account. You wouldn't necessarily call that a self-directed 401k, but I do want to add that a lot of times, this is especially uniquely true for law firms, where the annual fee for this self-directed brokerage account, as of a few years ago, was waived, and there's no limit to what you can put into the self-directed brokerage account. Whereas if you choose one of the core funds in what's called the American Bar Association's retirement funds program, you're stuck being forced to pay, although it's not as bad as in other plans, record keeping, administration, and custodial services and advisory services that are all built into the cost of those funds. If
Right.
you move your money and all you have to do is have a minimum of $2,500 in one of those core funds, but if you got $1,000,000, $2,500 is nothing, you could put all of the rest of your money inside the brokerage account and 100% completely avoid the record keeping, advisory, administration, and custodial fees through the use of that self-directed brokerage account, which allows you the full universe of investments within that custodian's platform, which is usually like over 10,000 different choices. Now, if you're talking about solo 401k, which people don't know they can set up, if you're calling that as self-directed, yes, if you're an individual business owner and you have no employees, then you can set up a 401k just with yourself as the only employee. And that can be traditional Roth or a combination of both.
I should have mentioned or defined self-directed. What I meant by self-directed 401ks is setting up through a third-party custodian rather than what as a traditional custodians like the Fidelities and Schwabs of the world. These third-party custodians allow you to open up self-directed 401ks, IRAs, and the like, so you can invest into a broader range of assets rather than public markets that are limited to what Fidelity provides or what Schwab provides. It'll open you up to private equity, essentially, investing your private equity into real estate, into gold, into a lot of different opportunities that you wouldn't have available if you invested through a Fidelity, if that makes
Okay,
sense.
good.
Yeah.
Thank you for bringing that up. I answered that, but not completely answer that. Within Fidelity, for example, Fidelity, and I didn't touch on which parties allow that and which don't. You can do that within Fidelity. You can have a self-directed brokerage account within Fidelity. And I think it's like you can put up to 95%, if I recall, or remember talking to them, your assets inside of that self-directed brokerage account. Even though it's true Fidelity, Fidelity will allow you to offer that brokerage window. But what if it's John Hancock, though? As of a few years ago, they stopped allowing you to put that money into the self-directed brokerage account. And there are a few plans, and I think maybe this is what you're talking about, where like you don't even have it a minute, like you just go direct to the custodian and
Correct.
everything's through that. That doesn't
Yeah.
happen that much, but theoretically you could do that with Fidelity too. Not that I'm like a huge fan of Fidelity. I'm just saying if you wanted almost all of your money in the brokerage account, Fidelity doesn't really care. Now, as for gold, I'm so glad you brought up gold, because I have been recommending gold and silver for years. And I was a little early because I didn't do it perfectly at the very bottom. And the market outperformed in like for 1 or 2 years, gold and silver a few years ago when I recommended them. And a lot of these custodians allow the gold and silver ETFs. And you can have physical gold in an IRA, but and I just looked into this, even if it's directly to a custodian, it's really hard. There's a lot of extra steps. If you wanted to own physical silver or gold in your 401k plan, it's going to be, no matter how you set it up, very difficult to do
Hmm.
that. But if you want to have a gold fund in any of these major platforms, advisors aren't very proactive. And I've argued in my ebook that'll soon be out why the 401k plan industry, or why the retirement system is not a free market. Advisors are encouraged to be conformist and adhere to best practices, and going outside of the norm and recommending gold and silver would be a great example. Although, due to Morgan Stanley's recommendation recently of 20% of all client assets being gold, maybe it is becoming the
Hmm.
norm,
Well,
that you almost never see gold and silver as investments offered in 401k plans, because advisors don't want to be too nonconformist. They don't want to rock the boat. They're not even paying attention to their own plan that they manage, because they're looking to get in the door to sell investments and insurance products to the high net worth individuals, and they only handle one or two plans anyway, so they look at it as a loss leader. They're not really taking the 401k plan seriously. And Ted Benna, the inventor of the 401k, has made the same criticisms as me in terms of the investment lineups, that advisors are wrongfully getting paid as if they're doing an original piece of work, which is really bizarre and inefficient. They need to get back to a fee for service model like accountants and attorneys. And yet all these fund lineups look the same. A 5-year-old could essentially pick the fund lineups, or sometimes I say a fifth grader, but I think it's even someone younger than that. Maybe a real smart homeschooled 5-year-old could figure this out, but there's no originality. It's very commoditized, very cookie cutter. And those are some of the reasons why you almost never see gold or silver in these plans. But even without the solution you recommended, you oftentimes can, at the very least, add a gold or silver ETF or mutual fund, or at least gold mutual fund in many of these plans with large providers.
Got it. Thank you very much for that. Are there certain business structures, I'm thinking S corps or partnerships, that tend to benefit even more from optimization of the 401k plans?
I don't know. This might be, I love to show how much I know, but sometimes I don't know things. And I don't know if an S Corp or a partnership would necessarily benefit anymore. I do know that it's definitely, no matter what, if you can afford it, especially if most of the money is the owner's money anyway. But even if it isn't, because it's good for the other employees, pay at the employer level for all of the reasons that I stated.
Got it. Okay. Thanks for that. What does a fair 401k plan look like from your perspective?
It's actually really simple. It's flat
Yeah.
fees. It's often low cost, passively managed index funds. It's commodities like gold, silver, platinum, copper, uranium. It's paying at the employer level, and it's the service. When you're paying at the employer level, it also encourages you to get a lot more out of the advisor. You want to be using the advisor regularly. And if the advisor is actually doing any real work, there is value. And that real work is sitting down, having one-on-one meetings with participants, helping them figure out how to use the record keeper's retirement plan calculator, where you enter your assets and your expected growth rate and your income and the expected rate of inflation and your retirement age and your life expectancy, and it'll tell you how much income you'll have during retirement, and it'll show you the differences if you make adjustments to that. It's not that hard to do on your own, but it's nice to have an advisor walking you through that tool, which you're paying for, don't forget, in these exorbitant fees. I mean, you're paying for these services, so you might as well use them. And the advisor is also helping you differentiate between the Roth and traditional 401k. Again, many people don't even know what a Roth 401k is, and they don't even know that it's offered, or sometimes it's not even offered, and the advisor has to make sure that it is. They do help select and monitor the funds, yet most advisors will tout that as the only part of their value, which is really too bad because the real work is the one-on-one meetings with the participants. And they will also help evaluate record keepers in terms of cost, services, and technology. A census is a great national provider. I get nothing from them. I have no financial arrangement with them. And all they do is charge a fee, I believe, as of a few years ago, unless their fee schedule changed, I got to get their updated one, of $4,250 for the first 20 participants for all the basic record keeping, custodial, and administration services. And an additional, I believe, $70 per participant for each participant above 20, plus additional fees for non-recurring services such as that cross-testing I mentioned, as well as plan amendments, maybe a few $100s every few years. That's very clear. It's very simple, and they have no restrictions on their investments. And they allow for the use of a self-directed brokerage account up to 75% of the plan assets. That's a perfectly good provider that a lot of people simply don't know about. So again, a fair arrangement is not only a transparent fee arrangement that's commensurate with the level of services provided, paid at the employer level, but also an arrangement where you're really truly getting a lot out of an advisor who's deeply experienced in the business and actually enthusiastic about providing advice to plans and participants, and not just trying to get in there to offer separate money management services and insurance products to the high net worth participants in the plan.
Got it. Understood. The next couple of questions are from the perspective of someone that has a small business that's starting out thinking about 401k. Do they
Mm-hmm.
design the 401k as a pretty straightforward plan, or are there special considerations? At what point does a company really start to unlock these more powerful optimization strategies?
Yeah, and that's a good question too. You can always have participants have their own IRA and not mess with it at all. Although some states now, like Illinois, if you have five or more participants, are requiring you to offer a group sponsored plan. It doesn't have to be a 401k, it just has to be something. Really, the more money you're making, the more you start want to start looking at 401ks.
Yeah,
There's SEP IRAs, and there's those are again are a little bit more restricted. They do have higher contribution limits than IRAs. A simple IRA also has higher contribution limits, and there's less administrative hassle with a simple IRA than a 401k. But the simple has higher contribution limits than the IRA, but it doesn't have as high contribution limits as the 401k. Or I should really say defined contribution plan, because some defined contribution plans are only 401k versus some are only profit sharing. But the defined contribution plan provides you with the highest contributions and the most flexibility. You can have employer and employee contributions. You can have a match. You can do this cross testing where you can disproportionately, again, allocate the contributions to the more highly compensated employees. And while the downside is that, yeah, it's more administration work and it's more expensive than a SEP or a simple IRA, there are some really efficient, not bad service providers that are also very low cost, that are fixed dollar fees, which is especially important if there's tons of money in the plan and not that many people, because you never want to be charged a percentage of plan assets if there's 10 million in the plan. And if let's say there's 20 people in a plan, just to reiterate this point, versus another plan that has 1 million and they both have 20 participants. Those plans are out there and everything else is equal. I can promise you that the $10 million plan is not requiring any more work. Now, in theory, I guess it could if that particular plan for an advisor might demand more of the advisor's time, but it's very possible that the advisor could be spending more time on the smaller plan.
interesting.
Just depends. Yeah.
Yeah, pretty interesting. What's the biggest mistake these startups make when they first roll out a retirement plan? Is it just that they're not investigating plans or they're overpaying in the fees?
Well, startups, it's not that much when you don't have that much money in the plan, but sometimes they'll use, let's say, a newer kind of provider like Guideline, which is now Accrue. And I've used them for a few plans, but I've moved on from them because their investment lineup is so restricted. Or they'll use another cookie cutter plan that's cheap. And ADP, at least, they don't restrict the investment, so that's fine. But the service isn't always that great. And it's that they just don't know enough to know what questions to ask
Mhm.
about cost, about services and technology, and they don't know the marketplace well enough and all the different providers. There's a few exceptions where some of them talked to 7 or 8 providers and they did a ton of work. And I really commend some people I've talked to that I think have done a really exceptional job. But most startup businesses just don't know enough to know what questions to ask and how to really do a deep dive in terms of all those different areas to really select a plan that's the best fit for their employees in terms of all the areas I mentioned being cost, services, and technology.
Okay, thank you for that. Joe, also as a startup, for a founder with limited runway, when does it actually make sense to launch a 401k? Is there like a threshold that you've seen where it makes sense?
I don't know if there's like an exact threshold, but the more money you're making and the more employee, like as you start hiring more employees too, and if these employees are decently paid, because even if
Right,
you have a few employees, a lot of employees when they're first starting out, again, depends on how old they are too. If these are young employees in their 20s, it really doesn't matter if you offer a match. I know people perceive the match as being good, and there's nothing wrong with
right.
the match, but the match is just another way to pay someone. Every dollar that you're paying in the form of a match could otherwise be paid in the form of salary, at least in theory. But if you're hiring older employees that are successful and you're at a professional services firm where people are highly paid, then you absolutely want to consider the 401k because you're preventing the employees from taking advantage of the higher contribution limits. If your employees don't have much money anyway, they're really not missing out on not being able to invest in the 401k. It's really the business
Right.
owner who A, can't get the higher contribution limits, and B, can't take advantage of sufficient profit sharing contributions. If you don't have a plan, then isn't it nice above and beyond what you can put away when you're maxing out to also be able to put another 30 or so grand in profit sharing contributions just for yourself. And if you have
Right.
enough money to do that, there's no reason, especially because there's so many efficient, low cost retirement plan service providers, defined contribution plan, that is, there's no reason not to set a plan up at that point.
So for founders, how can founders use retirement plans to reduce taxes without really hurting the company cash flow?
That's basically a summation of what we talked about.
Yeah.
If you're using a census, let's say you've got a like huge plan, like there's 30 people, but you got 10 million in assets. And that would be a lot of cash flow. And there's all these like and I see this all the time because I actually have an Excel spreadsheet that has taken me 17 years to compile, going through tens of thousands of publicly available retirement plan tax forms and segregating out over 1,200 of the most egregious examples of excessive fees being passed on to
Hmm.
participants just throughout the Chicago area alone. And it's always these cases with plans that have very few participants and lots of money that are shelling out 50, 60 grand, sometimes over 100 grand in participant expenses. If you were to just transfer that, let's say in most extreme cases, 100 grand with fewer than 100 employees to the company, you're like, that's a big cash outflow, right? But
Yep.
if you're smart and you're like, wait a minute, there's this provider called a census that would charge us $4,250 a year to do everything and maybe only a few $100s extra for some ancillary services, no
Hmm.
matter what our account grows to. And oh, since we're paying them a fixed fee and we're going to write them a check, maybe I'll start talking to an advisor about what time is actually required because our big account isn't causing the advisor to spend more time. Maybe we're paying the advisor about the same amount, maybe a couple thousand more. And sure, we're making all this money. If you got 10 million in the plan, a five to $10,000 cash outflow for a company that's obviously making money and putting in a few $100,000 in matching and profit sharing contributions is probably not going to significantly affect the company's cash outflow, but it's going to
Hmm.
save the owner or owners a ton of money because, again, not only were they getting screwed with the participant charges, but they couldn't even get a tax deduction for it. So it's a win for everybody and for the other employees, as I mentioned, whose fees will then go literally down to zero with the exception of the cost of the investments themselves.
Hmm. Interesting. Interesting. When companies grow from, say, 10 employees to 50 employees and onward, do the
Yeah.
plans change at all? Are you revisiting the 401k plans or defined benefit plans at all?
You might revisit because as the company grows, they might not have a defined benefit plan. And as the
Correct.
company's making more money, now they've got all this extra cash flow. They've maxed out the 401k, they've maxed out what they can put in profit sharing contributions. This happens with professional services firms like medical practices, architecture, engineering, accounting, and law firms all the time, where they then become ready to set up a cash balance plan because they know that their cash flows have increased so much. I guess hiring more employees doesn't automatically mean the companies become more profitable, but usually it's a sign of growth and there's more
Right.
discretionary cash flow. So you would definitely revisit that. And sure, the plan design could potentially change as there's more employees. Maybe you start thinking about more investment options to be added. Maybe you start thinking about adding that self-directed brokerage account because there's a better chance that at least one employee might want more flexible investment options, for example. Maybe you start using the advisor more often and conducting more individual and group meetings because now things are getting more serious. There's more employees and you've got to take your benefits a lot more seriously and keep thinking if you're wanting to attract new employees, maybe you develop some new marketing materials touting the fact that you're paying all the employee fees and you're actually giving all this extra compensation that all the competitors who are also small businesses aren't offering because they didn't even think to do this.
I like that. Are there tax strategies inside these retirement plans rather, that most like CFOs or founders completely overlook? I know you've talked about a number of strategies today, but are there specific tax strategies that they should be thinking about?
Within them, it's a lot simpler. And actually, this gets into the conversation about what advisors should get paid. You might be familiar with tax loss harvesting. That's a good tax
Yep.
strategy, right? When you have all these gains, you have all these losses. When At what point do you net the losses against the gains? And there's some real analysis that you have to do with that. But that doesn't apply to 401k plans or IRAs because when you sell investments within a tax deferred account, a qualified plan, there's no tax implications. So
Right.
all this additional complexity that advisors have to deal with in a brokerage account where you have to think about short-term versus long-term capital gains and capital loss carry forwards. There's a lot to deal with. And those are, I'm not saying those aren't valuable tax strategies, but they just don't apply within retirement plans. And of course, there's strategies about which accounts to withdraw from when you're, if and when you're advising participants about withdrawal strategies after they retire. And should the Roth be the last account to withdraw from? Now the required minimum distribution rules have changed where it used to be the year after you turn 70 and a half. And I believe it's 73 now. It'll go up to 75. So there's definite implications to when you withdraw that and keeping up with all the rules. But tax strategies within the plan are relatively straightforward just
Hmm.
because it's a tax deferred account.
Okay. Thank you for that. Now, I know we're coming up to the hour. Is there a question that I haven't asked that you think a company, small or large, should know about or should ask?
How do I look up all my tax forms? Sometimes people ask me that. And that's through the Department of Labor's site. I
Hmm.
think I can't remember the whole link, but if you just Google DOL 5500 search, it'll
Got
come
it.
up. And you can type in the name of any company that offers a plan. And all the tax forms for whatever years were filed will come up. Now, sometimes it's a little finicky where if you don't type in the exact name that is listed as the name you gave in the filing, it won't show up, but in most cases it will. And there's another site, you just have to set up an account. It's a free account called freearisa.com where you can also look up the tax forms. But the DOL site, Department of Labor, that is more recent. If you just filed the form like that day, it'll immediately show up where it takes a few months to show up on the freeerisa.com site. But it's a neat tool to
Hmm.
know that you could look up your tax forms, and the Department of Labor has the forms going all the way back if you file them that long to 2009 online at your disposal so you don't have to go looking for them in your office.
Interesting. Okay, thank you for that. There are questions that we always ask our guests at the very end. One is go back 10, 20 years to a younger version of yourself. What advice would you give yourself knowing what you know now?
I would say just be persistent and be patient because if you keep trying to figure out different ways to disseminate this message and go through the right channels right here. I never would have thought I'd be on a podcast talking about this and someone like you that has a big audience to get the word out that eventually if you even though people may hang up on you and they may say I'm not paying anything, if you keep focusing on the message and you keep telling the truth and you keep articulating the message clearly and you keep learning so you'll be able to articulate a more thoughtful message and a more comprehensive message, eventually people are going to start to listen and take action, and you're really going to help a lot of people.
That's great. Thank you. And I think you mentioned this throughout, but how do you give back to your community? And is what you're doing primarily in the Chicago area, or do you do this nationally as well?
Most of my clients are throughout the Chicago area as I'm making appearances on various different shows that are not always in my area. In most cases, they're not. I'm starting to work nationally, and I always have been able to. I'm only one person, so there's only so much time and energy that I have. But these issues are not unique. I'm in Chicago. They're certainly not unique to people who have participants in 401k plans in Chicago. They apply to everyone. And it's not just professional service firms, it's all types of organizations. So you should definitely look into it.
Okay. Thank you very much for the great conversation, Paul. How can investors find out more information about what you do and get in touch with you?
Thank you. You can just go to my website first. It's just my name, paulsippil.com, Sippil. There's also a Paul, Sippel.com. Don't go to that one, although if you want, you can go to that one too. But that's my website. There's a litany of information I have. A lot of my other appearances on other shows are on the site as well. And if you just type my name into YouTube, you'll see a lot of my YouTube videos. I've done a lot of YouTube shorts for those of you that don't have a real long attention span. And you go to either of those places, you'll learn more about the industry than people who've had businesses for decades.
Okay, very good. We'll include your contact information in the description of this podcast episode as well. Don't forget to like and subscribe to our podcast on whichever platform you're listening to make sure that we can continue bringing you the best educational content. Thanks, everyone. Until next time, keep learning to invest for generational wealth.